Welcome. In this video, which way will ZBCN coin go from here? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. From a technical analysis perspective, there is a very critical structure just below the current price level on the chart, namely a bullish order block. Order blocks are considered important areas that reflect market structure and especially the buying and selling behaviors of institutional investors. A bullish order block is essentially defined as a zone where strong buying demand has accumulated, and when the price returns to this area, buyers step in to support the price upward. Therefore, the current price level is technically in a very strategic position in this regard. Order blocks are generally known as price areas where large investors and institutional players actively take positions. These blocks are zones where liquidity accumulates before sharp price moves, and where significant directional changes in price occur afterward. A bullish order block specifically refers to a zone dominated by buyers where buying power builds up to push the price higher. When the price encounters such a block, it is seen as a potential support area, especially for short-term traders. The bullish order block currently beneath the price has the potential to be an important turning point in price movements from a technical analysis perspective. Because buyers have actively entered the market and pushed the price upward in this area before, it shows that this is a strong support level. When the price returns to this level, the likelihood of market structure and buyers reacting is high, strengthening the expectation that the price could bounce upward from here. The existence of such support zones plays a critical role in investors' decision-making processes, because as the price approaches the level of the bullish order block, investors are able to minimize their risks and maximize potential return areas. Traders looking to buy here assess the likelihood that the price will move upward with support from this block and shape their position entry strategies accordingly. The function of order blocks is not limited to supporting price. They also act as energy reservoirs for accelerating price movements. In other words, when the price approaches this support zone, the energy accumulated by buyers' pressure is released and can result in a sudden upward move. In technical analysis, this movement is called a bounce, and the presence of a bullish order block can trigger this action. Additionally, the overall market structure and trend direction are important for the effectiveness of the bullish order block. If the general market trend is upward and the price touches the bullish order block during a correction phase, the likelihood of the price continuing its rise from this support area is higher. In such a scenario, the bullish order block becomes a key support point for trend continuity, and an upward reaction from here is expected. In technical analysis, if such support areas break down, a significant shift occurs in market psychology, and the risk of the price moving to lower levels increases. However, in the current situation, the price holding above the bullish order block and attempting to stay at this level is a very positive development for maintaining positive momentum. To summarize, the bullish order block located at the current price level is a critical support area where strong buyer demand has accumulated and where the price has a high potential to react upward upon reaching it. If the price holds this level and buyers step in, upward movement may accelerate and new rallies may begin. Therefore, investors and traders are advised to closely monitor this level and adjust their positions and risk management strategies accordingly. But we cannot decide on the analysis solely based on the order block. Let's look at other metrics as well. Stay tuned. In the world of technical analysis, chart patterns play an important role in predicting the future direction of price movements. One such pattern, the W pattern, is a strong formation that often appears at bottom levels and signals a potential trend reversal. This pattern gets its name from its resemblance to the letter W in English, and is typically characterized by two lows with a peak in between. In the currently examined chart, a clear W pattern is observed, and the price appears to be attempting a rebound from the second low. The basic structure of the W pattern begins with the first low formed during the previous downtrend. This first low represents a level where the market enters an oversold zone and the price briefly finds support. After the first low, the price recovers somewhat, creating a turning point at the peak. However, this recovery shows that new buyers have not yet fully taken control, so the price falls again. At this stage, the price forms the second low. The second low usually occurs near or slightly above the first low. The price movement between these two lows gives important signals to investors. The current price level can be considered the second low of the W pattern. Technically, this is a critical support area, and the price attempting to reverse upward from here indicates the potential start of a trend reversal. The movement following the second low is important to complete the W pattern, and the price is expected to break above the middle peak and step into a new uptrend. For this pattern to be successful, the price needs to show a strong recovery from the second low and then surpass the peak at the midpoint of the pattern. This breakout confirms the W pattern and usually triggers a rapid upward price movement. Investors begin to consider buying opportunities once they see the pattern completed. Additionally, an increase in trading volume in the area where the pattern forms is an important factor supporting the validity of this reversal signal. The W pattern is closely related not only to technical indicators, but also to market psychology. While panic selling and fear dominate at the first low, the second low usually symbolizes market indecision and investors cautiously starting to buy again. At this point, the price attempting to rebound from the second low means hopes are renewed in the market and buyers are regaining strength. Moreover, the increase in volume during the rebound from the second low is the clearest indication that buyers are returning to the market and the upward momentum is strengthening. This volume surge strengthens the technical basis for the price's transition into an uptrend and suggests that the potential rally could last longer. In conclusion, the clearly formed W pattern currently visible on the chart, especially the price holding at the second low and trying to rebound from here, is an important signal for the start of an upward trend from a technical standpoint. This pattern allows investors to anticipate a trend reversal and position themselves accordingly. The price gaining strength from this second low and moving above the midpoint peak means the pattern is complete and potentially a strong upward movement is beginning. Therefore, it is crucial for investors and traders to closely monitor this formation, track support and resistance levels, and adjust their risk management strategies accordingly. In technical analysis, moving averages are used as important tools, especially in identifying long-term trends and analyzing market momentum. In this context, the 200-day exponential moving average is one of the most followed and trusted indicators among market participants and traders. A break above the 200 EMA level is often interpreted as a strong bullish signal in technical analysis, and should this move materialize, the positive momentum in the market is expected to continue. In the current chart, the price is testing this critical level, and if it can cross above this important average, the uptrend will gain sustainability. The 200 EMA reflects the long-term average price movement of the market, and the price hovering above or below this level gives important clues about the overall trend of the market. If the price stays below the 200 EMA for an extended period of time, the market is generally considered to be in a downtrend. In this case, investors act cautiously, reduce their positions, or turn to selling strategies. The 200 EMA indicates long-term trends. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.